Welcome back to the Fundamentalist channel. On this channel we cover market factor discussions, fundamental analysis, and technical reviews of stock charts. In today's video we talk about the upcoming market correction and practical suggestions on what you can do to mitigate this. We have seen optimism lately in the market. There are many reasons why this apparent recovery won't last. If we examine past market corrections such as the crash of 1929 and look at the chart patterns, we can see how the market won't recover from where it is today without another major correction. Bears always follow out-of-control bulls that exist when the market is overbought. When sellers overwhelmed buyers in February and March, the market crashed. When buyers overwhelmed sellers in April, the market recovered. The current market is fragile. It overreacts every day. Earnings season usually brings lots of good buy opportunities. This time, there were very few, and the company's stocks were getting whipped around in an unstable market. The buyers and sellers are irrational, even more than ever. There's still fear and volatility in the market. Confidence really isn't there. Profit takers and algorithmic trading are shaking people out like never before because of the excess emotion in the market. We are in phase 2 of a major bear market and crash. There's too much optimism. The stock market is being propped up today by government aid, a more than 10% recovery in 1 week in April. These gains were caused in part by the actions of the U.S. Federal Reserve and its attempts to boost the economy. Here's the reality. Realize it takes many years to recover from a drop in GDP of almost 25%, with millions and millions of people suddenly becoming unemployed. Expect many business closures to be announced in the coming months. Many will be from low-margin businesses such as restaurants and the retail sector. And we've been so engrossed in the pandemic, and rightly so, that we failed to build the uncertainty of the presidential election into the market. This will hit home later this year and cause a massive market reaction and correction prior to the election. Internationally, there will be government backlashes to the pandemic that lead to restricted globalization, national protectionism, and less democratic leadership. China and U.S. disputes are likely to escalate, causing massive stock market uncertainty. So everyone, there is a reason that Warren Buffett is hoarding a record amount of cash, said to be over $125 billion, as he did in 2000. In his annual general meeting, Warren Buffett said, "We don't see anything attractive. A lot of companies got the chance to refinance because of the actions of the Federal Reserve." So here's our tips on how to mitigate the upcoming correction. Number 1, use stop losses. Always have stop losses or sell-on stops at a point where you are comfortable with the risk of losing money. Risk is personal. We can't tell you what to do, where to put your stop loss, and we don't understand your financial situation, but manage these proactively in the coming months. Number 2, buy value stocks that either aren't directly connected to the market, the pessimism, or actually do more business in the upcoming months. Number 3, avoid volatility and avoid stocks that are directly tied to market factors and performance and that are affected by the fear and fluctuations of the market. These include airlines, cruise line companies, hotels, restaurants, and other in-person entertainment companies. Last of all, number 4, pay attention to your savings and debt levels. Build up as big a savings buffer as possible to weather job losses, reduced income, and market crashes. I hope you've enjoyed this video. We understand that each person's finance is unique, and I hope you've learned something to go forward in the upcoming months. If you enjoyed this video, please subscribe, like the video, and share. Thanks a lot, and stay tuned for more conversation.